Hey, what is going on, guys? My name is Nick, and in today's video, I'm going to be sharing when I plan on selling my stocks and the criteria to know when to sell a stock. As you might have noticed on my channel, I'm always talking about stocks to buy now or stocks that I'm watching to buy at some point in the future, but I rarely talk about selling. And when you're investing into individual stocks, it becomes difficult because you need to be right twice. First when you buy, and second when you sell. You can be right about a stock when you first buy it, but then you might end up selling that stock at a loss, or you might sell it too early and miss out on huge opportunities in the future. So I think it's very important to understand exactly when and when not to sell a stock to become a better investor, and that's what this video is all about. And don't worry, I'll be giving specific examples from my own investing journey to illustrate the concepts. So make sure to smash the like button if you do enjoy, and don't forget to subscribe to the channel so you don't miss any of my future uploads in the near future. Anyways, with that said, let's get straight into the video. Alright, so in the first part of this video, I'm going to be sharing 3 reasons why not to sell a stock. Starting with reason number 1, do not sell a stock just because the price has gone up. Now, this is a common mistake amongst newer investors especially, which involves taking short-term profits and or simply selling just because the valuation of a stock is too high. I've learned in the past that selling a stock just because the valuation is too high or it's reached your price target is usually not a good reason to sell, and here's why. First of all, nobody can time stocks or the market accurately. So what you might think is overvalued, another person might think is undervalued, and the stock price might just keep going up. And secondly, the market can remain irrational much longer than you can remain solvent. What this means is that even though the valuation of a stock might appear extremely high, it doesn't mean that that stock might come down. It might just keep going to the moon, and the company could eventually grow into that valuation just like Amazon has over the years. Now, I was very guilty of this myself when I first bought Microsoft stock back at $106 per share in 2018. Then I decided to sell once the valuation ran up quickly over the following months to $155 per share. As we can see today, that was a horrible mistake and should not have sold, even though the valuation looked high, because Microsoft's fundamentals were still incredible at that point. Look at Tesla stock too. Everyone thought the company was extremely overvalued when it ran up to $180 per share before the pandemic. Now, Tesla stock did crash along with many other stocks during the pandemic, and it might have made you look pretty brilliant if you sold at those highs, but then look where the stock price is today. It's over 5 times higher. Many people still think Tesla is overvalued at today's $1 trillion valuation, but it's very important to have a long-term mindset when it comes to investing. I personally refuse to sell my Tesla shares because I have such a long-term horizon that I have on Tesla, and I just see that they have a huge, gigantic opportunity ahead of them, and selling right now is probably going to look very cheap a few years from now. Alright, now moving into the second point, do not sell a stock just because the price has gone down. It's human nature to protect what we've earned through hard work by trying to minimize our losses wherever possible. In fact, psychologists have found that humans perceive losses to be far worse than the pleasure we get from the equivalent amount in gains. For example, if your stock dropped 20%, it would feel much worse than a gain of 20% would feel good, even with the identical amount in value. For this reason, we tend to sell our stocks to minimize our losses, but this ends up doing us a disservice a lot of the time. For example, when I first bought Facebook stock back in 2019 for around $180 per share, the stock continued tumbling over the next few months. Being a new investor, I really wasn't that confident, and so I thought I was wrong about the stock, didn't actually sell, but I also didn't buy the dip. All the while, the fundamentals of Facebook were still amazing, and the company was cash loaded to the sky. Now, looking at the stock price today, we can see it would have been wise to continue buying the dip and not even think about selling just because the stock price went down. It's important to remember in the short term, the stock market is a voting machine, while in the long term, it's a weighing machine, meaning that the intrinsic value of companies might not be priced into the daily and monthly fluctuations of the stock price, but over several years it will be. And thirdly, do not sell a stock just because you need the money. As a long-term investor, I don't know what's going to happen in the short term with my investments. They could go up or down, and frankly, I really don't care. For that reason, I only choose to invest money that I know I won't need in the near future or at some later date until retirement, and this prevents me from panic selling just because I need the money. For example, one stock that I purchased into quite heavily over this past year is Trulieve, in which I own several hundred shares, but look what the stock price has done over the past few months. Trulieve is down over 50% since the highs in March of 2021, and And if I needed this money for any reason, I'd have to sell at a loss right now, even though I know the stock is undervalued. And that's because, once again, in the short term, the stock market is a voting machine, while in the long term, it's a weighing machine. So I always hold cash on the sidelines as an emergency fund for expenses in my life, and I also borrow some money to invest using my line of credit to take advantage of undervalued opportunities as they come up. But it's very important to avoid margin at all costs, because your brokerage can actually require you to sell your stocks at a loss if you don't have enough equity in your account. So never put yourself in a position where you need to sell your stocks just to be able to fund your lifestyle or make sure that your portfolio has enough equity in it. It's obviously going to be at the worst time that you need to sell. All right, but now on the flip side, let's talk about 3 reasons why you might want to sell a stock. Reason number 1, sell a stock when that company's fundamentals deteriorate. It's important to know that companies are not static entities like a cardboard box. They're dynamic and always changing. So even though you did your research months or years ago on a specific company, it doesn't mean that that research is still accurate today. Sometimes the management of companies can make quick and rash decisions that end up changing the entire trajectory of that company, which may or may not be in the interest of the shareholders. For example, I ended up selling Carnival Cruise Lines, which is CCL stock, at a loss around $25 per share, while I purchased the stock for $39 per share on average before the pandemic. Now, the reason I decided to sell at a loss was not because the stock price went down, but it was because the fundamentals of this business deteriorated significantly. First of all, everyone's quite aware of how the cruise industry has been dramatically impacted by the pandemic, and even a year and a half later, we're still not back to complete normal. Secondly, CCL had to raise tons of capital via debt and equity financing just to stay afloat, pardon the pun, and that diluted shareholders significantly. As we can see here, CCL increased their total shares outstanding from 684 million in 2019 to 1.133 billion shares, which is a 65% increase in basically 2 years. This means that the company is going to have to increase their net income by 65% above 2019 levels just to be able to achieve the same EPS and thus the stock price. Moving forward, CCL will likely focus on repurchasing shares like crazy once they become profitable again, which would also help boost their EPS. But personally, I just don't want to wait around for Carnival to try and recover and potentially reach those 2019 levels again, which we're not completely sure of. I just think there are better opportunities available in the market. Some other examples of company fundamentals deteriorating significantly would be a dividend cut, taking on way too much debt, slowing revenue or earnings per share growth, fierce competition in the industry, and a few more. Any of those fundamental factors might be a valid reason to sell a stock and buy something else instead, but now let's get into reason number 2 to sell a stock. And that would be to sell a stock when a merger or spin-off happens. So a merger is when a company decides to buy out another company, thus the two companies end up merging together into one larger company. And mergers can usually create huge value to the shareholders of the company that's being purchased. That's because the purchasing company will usually pay a premium to the market value of the company being purchased. Otherwise, the merger likely wouldn't be approved by the board of directors of the company being purchased. As a result, the shareholders of the company being purchased could see an average immediate gain of 20 to 50% once the merger happens, and this could be a good time to take profits. For example, Rogers Communications over here in Canada announced on March 15th, 2021 that they would be acquiring Shaw Communications for $40.50 per share. At the time of this announcement, Shaw was trading for around $24 per share, and on the news, Shaw's stock price jumped over 45% up to $35 per share, where it still remains many months later today. Now, since there is still risk that the merger won't go through, investors aren't willing to pay up to the acquisition price of $40 per share. But once the merger does happen, those Shaw investors will get the full equivalent amount worth in Rogers shares. Now, if I were a Shaw shareholder, I would have sold out of that position completely on this news to lock in that 45% gain and then redeploy that money elsewhere to be able to see a larger gain over these next several months. Now, another similar but opposite scenario would be to sell your stock when a spin-off occurs. According to Peter Lynch, spin-offs occur because management thinks that their company is undervalued by the market and believes with good reason splitting up the business into a simpler structure will force investors to revalue the spin-off and parent companies more in line with comparable companies. So essentially, this is just the opposite of a merger, where a company might choose to spin off one of many parts of a larger business into its completely own entity with their their own shares, and this can usually be accretive to shareholders of the parent company. For example, Facebook, now known as Meta, was sued in December of 2020 by the Federal Trade Commission, or the FTC, because of supposed anti-competitive actions by acquiring Instagram and WhatsApp, which left them with very little competition in terms of the social media world. The FTC's goal with the lawsuit was to force Facebook to separate from its acquisitions, such as Instagram and WhatsApp, so they could compete with Facebook as independent companies. Now, this would give current Facebook investors shares in all three of these companies, WhatsApp, Instagram, and Facebook, which is actually thought to be accretive to the shareholders because Facebook's valuation is so incredibly cheap right now. Now, in Facebook's case, they really wouldn't have much of a choice here if they did get sued, but some companies do choose to create these spin-offs just to boost shareholder value. In either case, investors might consider selling their shares to take advantage of those quick gains and then redeploy the money elsewhere, or you could also keep the money in that new spin-off company, which Peter Lynch has recommended, and then just sell off some of the parent company's shares if you don't like it. And finally, the third reason to sell a stock would be when a better opportunity comes around. As I've mentioned a few times already in this video, I've sold stock before because a better opportunity arose. The stock market is all about trying to find the best risk-reward opportunities, and there are always new opportunities available in the market. Unfortunately, holding on to a stock that really isn't performing up to expectations can lead to a huge opportunity cost if you end up holding those shares and they just aren't doing anything for an extended period of time. Opportunity cost is just the benefit that could have been obtained if you went with an alternative, which in this case would be buying another stock instead. So in my earlier example where I decided to sell out of CCL stock completely, the decision was twofold. First of all, the fundamentals of the company deteriorated significantly, and then secondly, there were better opportunities available for me in the market at that time, which, for example, was Facebook. More recently too, I actually trimmed my position in Apple a little bit to buy more Facebook when it dropped after earnings because the valuation was so tempting. Now, does that mean that I don't think that Apple stock will go up? Well, no, that's not the case. I do really love Apple as a company, and that's why I still own their shares, but I felt that the opportunity cost of not owning Facebook stock was higher than the gains that I could have got by just holding Apple stock at that time. So one lesson you might take out of this video is to never get too attached to a stock. If they aren't performing as expected and there are better opportunities available to you in the market, dump that stock and buy into the better opportunity. That's why I'm always doing research to try and find great new stocks, because there's always different risk-reward opportunities in the stock market, and it's always changing. The stock market is so dynamic. Overall, to answer the title of this video, I do not plan on selling my stocks anytime soon, but if I do decide to sell, it will likely be because the fundamentals of that company have deteriorated significantly, it's involved in a merger or a spin-off, and thirdly, I might just find a better opportunity in the market to invest. Most likely, however, I'll be holding my core stocks like Apple, Meta, Amazon, and Trulieve for the next 5 years without even thinking about it because of their current fundamentals just being incredible. So let me know down below, when will you consider selling your stocks? Are there any other reasons why you would consider selling your stocks? Just let me know if you agree and if you have anything else to say. So anyways, guys, if you did enjoy the video, make sure to drop a like, as it does help out my channel tons, and don't forget to subscribe for more content coming very soon from my channel. Anyways, with that said, I will see you guys in the next one.